Hi, everyone. This is Andy Hart, Delegate Advisors. I'm here today with Duncan Allison, the Director of our Portfolio Management. Duncan, I'd love to have a brief chat with you today about what we think about the markets and what we're hearing from our clients in the way of questions that they have.
Good morning, Andy, and thanks for taking the time.
Maybe we'll start with the first question, which is we're hearing a lot of comments that the market seems to be totally disconnected from economic reality. What do we think about that?
I don't disagree in some aspects. I think there's two things that I would point out that we see today that make this recession different from any other one we've experienced as of lately. I think the first one really is the size of the fiscal and monetary stimulus, across the developed world. It dwarfs the level of stimulus we saw, in the great financial crisis. As part and parcel to that, the growth in the money supply has been materially substantial when compared to what we saw in 2008. So I think that in itself is one big factor. I think the other big factor, is really that personal disposable income has actually grown during this recession, not shrunk, as we see in most previous recessions. So I think those two things have really helped buoy the economy and allowed the market to appear a little bit more resilient than what people are seeing day to day. So Andy, we were talking the other night and you mentioned this is your fifth recession in your professional career. What sticks out as different this time around than your previous experiences?
I think the number one thing that's different today is the Fed. Some people look back at Greenspan and asset bubbles as we started to look at the impact that the Fed had on markets, and then when and there was some speculation that the Fed might bear some responsibility for the buildup of asset bubbles, but then during the run up in the home prices and the reaction that the Fed had through the Great Recession was considerably greater than what we'd had in previous recessions. And then lastly, today, the actions that we've seen the Fed taken are a 5x what the Fed took back during the Great Recession. So I'd say the key factor that's different today from prior recessions is how active and willing the Fed has been to pump literally trillions of dollars into the economy.
When you think of just these levels of government debt, and if you look at the different ratios of debt to GDP, what comes to mind that's different today than you've observed historically?
The key factor that's different today is just the willingness of the government to shift the debt onto the balance sheet, effectively penalizing or putting that into the pockets of future generations. So they'll have to pick up those liabilities down the road, and that's either going to come in the form of higher taxes or less government spending. And I don't know which one of those is going to occur, but we're now approaching debt levels that are concerning. What are some of the themes that you think are going to play out in 2021?
I think there's several themes that the market has, really priced in. And the first being sustained government spending. And whether that's a COVID relief package or additional policy initiatives to support education, healthcare, and infrastructure, I think we're going to see substantial government spending in 2021 and continued in 2022. The second factor is really a rebound in consumer spending in the second half of the year. The impacts from the pandemic, resulted in high earners benefiting from an increased savings rate and lower income earners benefiting from generous transfer receipts that we just talked about. And then I think lastly is really that we're going to see continued aggressive monetary policy from developed market central banks, at least through 2021. So I think the market is really priced in those factors, which I think is really driving a lot of the returns that we've seen so far year to date. I think if any of these three factors really, catch a big hiccup or, see a big hurdle from coming to fruition, I think the market will react negatively.
So Duncan, for 2021, what do you see as the key risks?
I think there's four key risks. And I think the first two that I'll mention, you know, if they came to fruition or were realized, would have the most impactful outcome on the markets today. And I think the first one is really rapidly rising and higher interest rates. And whether it's the impact from, higher interest expense, which is likely to result in lower capital spending and consumption, or just the impacts it has on market valuations, that's a big concern. I think the second biggest concern really is the size and efficacy of fiscal and monetary stimulus, going forward, and whether, the market is, over anticipating the size and the efficiency. Only time will tell there. I think those are probably the two largest risks. I think there's two other risks that can't be ignored. One being, China and the U.S. And we've continued to see this line get blurred between, trade policy, intellectual property, rule of law, and national security. And I think a large disruption in the China and U.S. relationship could really have an adverse impact on markets. And lastly, I think an unexpected increase in corporate default rates and severities could really throw the market a curveball. We have seen corporate credit spreads blow out to recessionary levels, 3 times in the last 11 years. And we've really only seen one, technical recession, which was driven by a pandemic, not balance sheet leverage. So I just think that something that comes out of the blue within that sector, and when it comes to default rates and severities really exceeding expectations, could have a pretty material impact on markets. I'll turn it back to you, Andy. What do you see as the biggest risks when it comes to long-term planning initiatives for clients?
I think the biggest risk that we see is the administration's focus on tax law change. Two parts to that. One is a change in the estate tax. So clients who have not already taken advantage of their lifetime exemptions should think about talking with their counsel about how best to apply those exemptions, because the general consensus is that they're either going to sunset the law early, meaning they'll take the current law and let it expire. It's not set to expire until the end of 2025. And when it expires, it's set to go from today's exemption of about 11.7 million per person back to 5 million. So that's a major shift. And then the second would be a significant change in the capital gains tax rate. The proposed changes in the income tax rates aren't so high, going from 37 back up to 39.6. But the proposal to think about doing away with capital gains tax, meaning, the current 20% rate, and just having one tax rate be the ordinary rate for all sources of income, whether it's capital or whether it's interest income, that would be a huge shift in terms of people's thinking about how to manage their portfolios. And then I'll back up 1 second and just sort of also comment on one of the other major things they're thinking about doing away with in respect to estate planning is the basis adjustment. When a person passes away today, there's an adjustment of their assets to fair market value. And that goes both ways. Most people think of it as a step up in valuation where you paid $1 for something and it's worth $10. The other way also counts in that if you paid $20 for something and it's only worth $10 today, you lose that capital loss. So the basis adjustment, though, for the most part, is a huge benefit. And if we lost the basis adjustment, that would also be a major change in tax law, and we'd have to rethink how we think about estate planning. Duncan, we've had a lot of conversation about the change in administration and what that might mean for us. What are you thinking?
Yeah, I think the most important component of the Biden administration's plan, is really the change to the corporate tax rate. And not only the statutory rate of 21%, but also industry-specific changes that may affect the effective tax rate for certain industries. So I think, that's first and foremost. I've seen estimates out there that would show a roughly a 10% decline in S&P 500 EPS, based on the proposed Biden plan. But that's before any sort of positive impact from additional, government spending that's anticipated. So I think the big long-term risk is the environment domestically becomes business unfriendly. I don't see that happening overnight, but it's definitely, remains a risk.
Earlier in the conversation, you mentioned that valuations were high. And, I just wanted to circle back to that for a second to kind of pick back up on that. So how do you think the current state of valuations impacts our thinking, and how do we want to communicate with clients around that topic?
Yeah, there's no doubt that valuations are elevated across the board. Regardless of what metric you look at, most would indicate, being in some sort of top decile valuation. And I think it's tough to invest in this type of environment. I think a lot of it is reflective and driven by the low interest rate environment that we're in and are, most expect to remain in for the near term. I don't think that's going to last forever. But it's tough to really fundamentally back into the valuations today. Even if you think that, S&P 500 earnings kind of get back to pre-pandemic levels by the end of 2021 and really have some solid growth in 2022, it still doesn't really move the valuation metric too far where it's that meaningful to say, hey, these look attractive or fundamentally sound. So I think it's a tough market to invest in. I think you have to be patient. I think you have to embrace dislocations when they arise, which I think is somewhat inevitable in a world of growing uncertainty, both, from an economic and political perspective. So I think it's tough, but it's also tough to say, well, I don't want to be in this market and I'd rather be in core fixed income, which, we think is just as overvalued, if not more overvalued than public equities.
So what does that mean for a client who's got a lot of cash available in the bank and they want to put it to work?
It's an opportunity to add some active management to your portfolio. I think that Delegate has always preferred some sort of passive implementation in efficient markets. I think in a market where valuations, are persistent at these levels, I think active management will have the opportunity to outperform over the near term and potentially long term. I think there's other technical factors in the market that make traditional passive implementation challenging, given the growth we've seen in cap-weighted indexing and passive products, whether in ETF form or other forms. So I think it's an opportunity to add some active management where they're really looking at great businesses that they feel can either grow in isolation or benefit from certain secular changes.
So Duncan, we spent a lot of time talking about valuation metrics and about how clients can think about putting money to work in these markets. What's one sector that you think we would be focused on in 2021?
I think real estate is probably going to see more dislocation than any other, large asset class. Obviously, certain sectors like airlines, leisure, hospitality are going to suffer. But from an asset class perspective, real estate's likely going to see the most dislocation, just given the changes in consumer and business behavior. Yeah, I think there is going to be a lot of opportunity in real estate, but I think generally, most sectors of real estate come back to pre-pandemic levels, but it's going to vary based on asset type and location. The high density, high volume markets of New York and San Francisco are going to continue to suffer, based on some of the changing trends in, remote working, but also how corporations think about the utility of their space and the cost per square foot of, per employee. So that's one factor. I think the business travel is going to have continued impact on hospitality. I don't ever know if business travel will come back to the degree that it was pre-pandemic. If it does, I think it's going to take, you know, several years to get back to those types of levels. But I think, from our perspective, we've been very efficient with virtual communication, but it can't replace everything. So we look forward to getting back to business travel, seeing clients, seeing managers, but I don't see us getting back to pre-pandemic levels anytime soon. And I think third, one important aspect that we like about real estate is the potential for long-term inflation hedges. Whether that's, from increasing rents in multifamily to, long-term lease contracts with embedded inflation escalators. One big risk we see long-term from all of this fiscal stimulus and the growing deficit is potential inflation. So we like the aspect of real estate. We're very focused on, asset and asset location, which is always paramount in this type of strategy.
So then lastly, it's hard to ignore all the comments and things we're reading about Bitcoin. So what do we say to clients who ask us what we think about Bitcoin?
I think when it comes to Bitcoin, there's several important factors to consider. I think the first really is the utility of the blockchain technology, which, we have zero doubt that the technology has tons and tons of applications across businesses and industries. The big question is whether, Bitcoin becomes a viable fiat currency or a store of value. Today we think it's too volatile to be considered a store of value. I can't imagine anyone that says, hey, I want to go stash all my extra cash away in Bitcoin because it's going to make me feel really, really safe at night. And it's hard to imagine governments not imposing regulations. It's hard to imagine that theft and fraud is not rampant in an asset like this that's unregulated. And, so the way we think about it is, look, it's all about adoption. And, if Bitcoin becomes a digital asset that people utilize as a fiat currency in the future, it's going to be a tremendous investment. If not, it's probably going to be a really, really poor investment. So we think it's a very binary outcome based on adoption. And for us today, we're not recommending it to clients, for any sort of material position in their portfolio. Down the road, that could be a wrong decision, but it's very, very difficult to speculate on those long-term risks within this type of, thesis.
Well, Duncan, I really appreciate the time you've taken today to kind of catch up with us and for the thoughts that you've shared with me and with all of our clients. So much appreciated, and we should do this again soon.
Yeah, thanks, Andy. Have a great day.
You too.